And please allow me to introduce our panelists. Nick Carter, the managing partner of Castle Ventures. Dan Heddle, managing institutional accounts for crypto and Kiao from Masari. I think this week is a pretty significant week. 10 years ago, Bitcoin came out as this peer-to-peer experiment. And just looking around the city this week, seeing all the central bankers and regulators and financial institutions coming together to discuss the potential of peer-to-peer magical internet money, solidifies the concept that a lot of us are 90% certain that crypto and blockchain are the future of financial market infrastructure. And I think for the sake of this discussion, we want to actually look at on-chain data analytics and the ramification of that data on the markets for the next 2 to 5 years. Maybe in 100 years, crypto is going to replace the dollar. Maybe it's going to get debunked, and it might just be a settlement layer. But right now, I think there is a lot of on-chain data discussions, debates. How do we interpret all this data, and how do we value these assets? So just to begin, I would actually have each of you share with us what your favorite data analytic tools are, and what... I don't know if you're going to refer to Coin Metrics, but please do. And how do you distinguish between on-chain data, off-chain data, and different dev information that you use to discern between the noise and the signal that we have going around in this space?
So I'll use the mic, I guess, for the benefit of the people listening online, right? So I'm Nick Carter, partner at Castle Island Ventures and co-creator of Coin Metrics, which is a blockchain analytics kind of website. So that's obviously my favorite, but some other honorable mentions. I like Blockchair, if any of you like really granular querying for information related to like Bitcoin and Ethereum, to find like interesting like data hidden in the blockchain. Like you can search all the op returns, which is really cool. So like if you search like marry me, you'll see like a bunch of proposals inscribed into the Bitcoin blockchain on Blockchair. And that's, yeah, it's an amazing site because there's like this unbelievable richness of data hidden within these things, which, you know, so people think they're, you know, just removing money around, but they're incredibly rich and deep, and there's, you know, a ton of like cool Easter eggs hidden in there. So that's another favorite aside from Coin Metrics.
So I'm sitting between the guy who co-founded Coin Metrics and Masari. So I can't really win on choosing one or the other, so I'm going to say both. They're both my favorite data tools. I think they both have individual things that are really unique. On Masari's side, the alts versus BTC rate is something I use to monitor prices consistently. I think you guys do that in a very elegant way, especially since it's real time. And on the Coin Metrics side, it's something that I use often for kind of deeper analysis. I want to go in and kind of dig into the weeds of, for example, median transaction fee over median transaction value. Something that's like a little bit more granular, and I can export that data and then work with it.
This is Chao here, head of product at Masari. And previously I was a trader for almost a decade and also helped build a product at Bloomberg, institutional kind of data product. I think there are many tools currently that in crypto that I really like. Coin Metrics is definitely one. Masari is another. There are like, I can name like 12 other different really good tools. I think right now the landscape is very scattered. You can find information in a lot of different, useful information in a lot of different places. There's not really one, one-stop shop for crypto-related data and information. And that's sort of what we try to build at Masari. But some honorable mentions, Flipside Crypto, sort of similar to Coinmetrics, good blockchain, on-chain data. Nomics, for example, provides very good market data. And yeah, like there are probably a few others to forget.
Continuing the theme of noise to signal, there are various signals that don't necessarily quantify to financial metrics, such as front-running or real volume data off exchanges. And Masari is very famous from taking the Bitwise research and making that into the real 10 volume. And so the question is, A, why did you choose specifically those 10 exchanges? And two, what kind of metrics do you rely on to know and self-correct for the real volumes? And continuing that line of thought, do you think regulation or regulated exchanges is a solution coming at us that could resolve some of these issues?
I think this is a very good question. So before Bitwise released their report, we did a bit of internal analysis of watch trading, and it turns out that our analysis matches that of Bitwise very closely. And the kind of analysis we do is, so for example, you can look at the trades that happen between the best bid and best ask. If a lot of these trades happen, chances are it's a watch trade. But because like trades must happen at, like normally a trade should happen at the best bid or at the best ask. So a lot of these like non-real 10 or fake volume exchanges that people have suspected have fake volume, this happens a lot. And one thing that's really important to understand is the real 10 volume probably underestimates the actual real volume, because the definition of these real 10 exchanges is that those exchanges that we have high confidence, high conviction that have real volume. But that does not mean that something like BitMEX or other exchanges don't have real volume. And in fact, even if like some exchanges that we think have a lot of fake volume, chances are like at least 10% of their volume is real. So that's something to be to take into account.
Do any of you guys have anything to comment? I mean, how do you address both the front running and the numbers in order to see what is the real volume that we see?
Yeah, I think something that'd be interesting in the future is a combination of OTC plus liquid plus lit markets, which are the exchanges the venues that we normally go trade at. This would be the Bittrex, Coinbase, etc. I haven't seen anyone combine the two. Getting the OTC numbers is somewhat difficult to get. Some people are pulling that data together currently, so I think that'll be interesting in the future to get the true capture of volume. When it comes to fake volume, I thought the Bitwise analysis was really, really cool, how they dug in deep. I think they looked at like average order size and time stamping and really going in deep on that, and I thought that was really, really cool. I'm not sure how many people have seen it, but the way, the in-depth nature as to how they examined it, I thought was fascinating.
Yeah, I'll echo that. I think Masari really did a fantastic job, kind of productizing some of the conclusions Bitwise had and creating a useful, kind of whitelist of exchanges. Obviously, there are other exchanges which have some volume which aren't on that, but I think as it's like an incredibly good first effort. And you have to be opinionated about this stuff because there are like structural problems in the market, which mean that, in my opinion, exchange data just by default has low integrity. So the vast majority of crypto exchanges are almost completely unregulated. And the kind of entrepreneurial nature of starting an exchange, because you have the clearance and settlement layer, which is permissionless, so anybody can really start one. And the growth hacking tactic is obviously to forge volumes and make your thing look liquid. So it's going to be a default feature of virtually all of these exchanges. And you have people like CZ admitting that he did it when he was CTO of OKCoin. This is in the public record. it's like it's not a conspiracy. He wrote it on Reddit. So you kind of have to acknowledge that the data is faulty by its nature, and then if you want a good proxy for what real volume is, then you have to whitelist as opposed to blacklisting, I think.
And to kind of expand on that a little bit, I thought what is interesting is bringing in some data outside of market data or on-chain data to go evaluate the true liquidity of these certain crypto assets or the volume that's actually being traded. And I think this was Bitwise, it might have been you guys though, I forget, where you guys focused on search traffic, or like how much traffic the website was receiving versus the trade volume. And I thought that was a really fascinating, different way to look at that data versus trying to quantify like, oh, the certain order size at a certain time. Just looked at how many people are going to the website versus how much trade volume are they reporting.
Yeah, sorry, just not to keep this going too long, but one thing I think will be a feature of kind of data analysis for exchanges will be an assessment of their reserves. So this kind of goes into the proof of solvency idea, but really the idea is that having a cold wallet full of coins is a costly thing to forge. Obviously you can borrow coins, but on an ongoing basis it's hard to forge your true sort of collateral. And these, if let's say you knew the balance held by wallets for each exchange, you could then compare that to the claimed trading volumes, and you could see, well, Coinbase has a ratio of whatever, 10 to 1 on a weekly basis, and then you could, easily target the exchanges which are making up numbers. And that's just a function of doing a little bit of detective work and auditing, what their cold wallets, balances are. But I think, that is the beauty of crypto, is that the ledgers for the most part are transparent. Some people don't like that. I like that very much. And I think we're going to either see voluntary audits, like some of these exchanges have created proofs of solvency and they actually disclose how many coins they have in their vaults, or involuntary audits where third parties, like some of the people in this room, will go and find out, how many coins they have, and then compare that to the claimed volume, and then, the fabricators will be, very clear.
So let's look at the last month. We had two pretty big dramas in two of the largest exchanges. One with Binance in terms of the site hack, and two, Bitfinex with Tether. Both of them would have been resolved a lot quicker or with more transparency if they really did use a proof of solvency. The question is, do you guys think that the industry is making more and more steps towards making those kinds of proofs transparent, or bank reserves within fiat accounts or omnibus accounts? And should we demand that as a community for that to be publicly disclosed, even on-chain?
Thank you for the kind of the question, which is like the main thing I care about.
Welcome, Nick.
I mean, I don't think a proof of reserve stops a hack, of course. Like, Binance, if they're going to get hacked, they're going to get hacked. But what it does is like it builds trust in an industry where trust is lacking. One of the issues with Tether is that they issued like 3 attestations over a period of like 4 years or something. And the other stable coins learn from them, and they have like monthly attestations, if I'm not mistaken. So I think it should be something we absolutely demand. And it's not that cryptographically difficult to construct a simple proof of reserve. There's a British exchange, CoinFloor, which has done it for 60 consecutive months, 60. So, Coinbase and Kraken tell me they can't do it. I don't have that much sympathy for them. It's like a Merkle proof, basically. It's not that complex. So I think it's a feature we really should demand of exchanges. I don't know if you guys...
Yeah, I 100% agree. It should be standard. It should be a standard operating procedure of any exchange, which is to validate that you hold the assets that we believe that you're holding. I think they'll only do it once the market demands it, which is all of us. Or there's an exchange hack and people want to know exactly how many coins were stolen. So I think it's up to the users or the customers of the exchange to really demand this. And I'm not sure that'll happen unless there's like a big painful moment where they need to bolster trust with the customers.
But that's why they did it after Gox. Some of them.
Is that why CoinFloor did it after Gox?
They got started, I think, in 2014, 15.
Yeah, they were the British exchange. Yeah.
Yeah.
British- yeah.
They started doing that, I think, later on, like 2016. That was after there was an OKX.
Yeah, and Kraken did one after Gox, and they said they would keep doing it. They obviously didn't.
I feel like Jesse's the closest one who would keep doing it.
I would love them to keep doing
He's
it.
pretty OG.
Yeah,
Yeah. We should get Kraken to do it.
I asked him.
Yeah.
He didn't answer my DM.
Do you want the whole panel to ask?
What? Everybody
Jesse to do a proof of solvency?
Guys,
like-
if you're listening, everybody DM Jesse Powell and ask him for a proof of solvency.
There we go.
Well, thanks, Maya, for giving me the opportunity to show our project, because this is exactly what we do to bring transparency to the market. We've done that for token projects, the so-called Messiah registry, where projects disclose information such as their vesting schedule, their on-chain address, where they store their tokens, and so far it's been great. And we've actually started a similar initiative with the exchanges. I think in this industry, you need someone who can bend the reality to their will, to make something happen. Because otherwise, exchanges are not really incentivized to do this. You need someone who can bootstrap the two-sided network of exchanges providing information and the market demanding that information, and that's exactly what we do. So we've been working with a lot of exchanges, especially the non-US regulated exchanges, because in general, US regulated exchanges like Coinbase, they should be
Yeah.
okay.
Yeah.
But for the ones that are not, in the US regulation or Japan or some other areas, we need that kind of stuff. So we're working on something similar to the projects, but with more exchange specific information, such as proof of solvency, kind of insurance they have, what is their watch trading practice, are they using any third-party software provider to check for watch trading?
Like surveillance tools.
Surveillance tools. So it's definitely we're definitely going in the right direction as an industry.
So let me go back to what we were discussing earlier, the proof of solvency and Tether. I think both these dramas, specifically the Bitfinex and Tether, one demonstrated that Tether is really the inter-exchange settlement unit that we keep on using, and two, it also showed a counter-incentive position within the crypto markets where the entire markets is willing to not punish Bitfinex because everyone has too much at stake to let them fail, and we let them introduce another exchange token such as BNB, where we have exchanges basically taking three sides of a market: the buyer, the seller, and the cash flow coming in through the exchange tokens. The question, how does that really fit in manipulating A, that exchange data, and B, on-chain data for the entire ecosystem?
It's a very broad question. I don't know where to start.
So let's be more specific here. You have Binance coming out with Leo Coin, which is a very brilliant investment because they are in need of liquidity and are able to provide that. They're going to list new tokens on Bitfinex as the seller.
Mm-hmm.
They're buying some of that as the market making side, right?
Mm-hmm.
And then they're providing allocations through the Leo Coin.
I see what you mean.
So you have three sides of transactions that basically go into that specific exchange before it gets settled on-chain,
Mhm.
right? And they can take two sides plus net in the fees.
I think we're seeing a lot of same money getting washed in the cycles within this is one of the many examples. So previously we've seen allegedly EOS with washing their ICO money through the Ethereum blockchain. I haven't seen any evidence myself, but I mean allegedly they've done that. And we're also seeing investors putting money in crypto projects and then themselves investing in some crypto projects, and then the money basically cycles through a few entities, and that's in a way it's I'm a little bit worried about it because it could create a lot of leverage in the industry, unnecessary leverage, and leverage in an industry that's largely unregulated is very dangerous. I have a thesis that in the absence of regulations, we're gonna see way more derivative trading, way more leverage than traditional market. And that's dangerous because with leverage you can blow up very, very easily and very, very violently. So that's something that worries me a little bit at this point.
So let me kind of, sorry, yeah.
I think we see this both in it's a worrisome nature between the different VC quasi-hedge funds that have invested in certain ICOs, and those ICOs then invest in hedge funds.
Or they
And
invest in
so-
other ICOs.
Or they invest in other ICOs, and so on and so forth. Also, the decentralized lending, I think, is something that people don't adequately think about. Like MakerDAO, like what's the rate at now? 20%.
Almost.
Almost.
Yeah.
Yeah.
I think these are really cool experiments that we can try, but there could be some unintended consequences that might be very tragic.
Yeah, I mean, just to echo what these guys are saying, the recursive ICO thing is highly perturbing. And we actually have plenty of examples of this happening. You raise money and you don't know what to do with it, and you don't have anywhere to spend it, so you take your foundation, you just put it in other projects.
Treasury management.
It's pretty wacky. Actually that there'd be great use for a proof of reserve tool for foundations. To disclose that they're being, that's actually why I kind of like cryptocurrencies for charitable or foundation purposes, because you can be very clear about what you're spending your treasury on, and that's just like native auditability. Kind of a side note.
Okay, so the different ICO washing and recycling of these funds, I think, is a really fascinating conversation, because really, if you look into forensic analysis, all of this data is on-chain. And you can look per ICO, per pre-sale, what happens with the treasury, and really tell the story of that ICO and who it's funding. How do you explain that hasn't been either uncovered on a mass scale or basically tracked and re-audited within the industry?
So that's actually not quite right, because exchanges are these black boxes where the paper trails kind of terminate. So for the EOS case, a lot of the problem is that if you're not familiar with the sort of like EOS problem, is that there was they accepted funds into the crowd sale. Apologies to any EOS fans in the audience. And then during the crowd sale, which lasted about a year, there were many outflows from that same wallet. So what they could have done, we don't know for sure if they did this or not, was take those funds and then posture that they were buying their own crowd sale with the committed funds, which would have given them a costless, any fraction amount of EOS that they wanted. And so Block 1 said that they were limiting themselves to 10% of EOS, is that right? In terms of their own allocation. But if they'd done this surreptitious circular thing, they could have ended up with 99.9% of all the EOS. So that's kind of the issue, and that's why people said, well, they should have kept the crowd sale wallet, fixed and not done new withdrawals until the end of the sale. So then if you look what actually happened, all the funds went to Bitfinex for the most part. So that's the black box. So we don't know what happened in Bitfinex, so that the trail kind of terminates there, like only Phil Potter knows, basically.
It's a classic technique. I'm not sure if anyone in this room was a member of BTCE, the old fond Russian
That's a
exchange.
throwback, yeah.
Oh, BTCE was lovely. All you had to do was have an email, and in broken English plus Russian, you signed up, and then you could trade hundreds of millions of dollars. So yeah, back in the day when BTCE was still running, I think it might be.
They closed it down because they washed the GOX coins.
Yeah, they washed the GOX
That's
coins.
why it was set up.
People often would send, you send Bitcoin in, then you buy Litecoin, and then 6 hours later you buy Bitcoin again. And so that's a black box, and that's what Nick's referring to there, is that black box only BTCE knows.
That's
So one
why they were
last
targeted.
question going forward. We have a few more back boxes that are going to be introduced into our system, either privacy or lightning settlement, or even DEXs and some dark pools with on-chain privacy. How do you guys think you're going to be able to maintain that transparency or access to the data that we have right now, or whether it's going to be harmful for the industry in terms of pricing with on-chain data.
I haven't thought too much about this, but I think over time, my hunch is over time, the privacy technologies like zero-knowledge proofs will be more and more prevalent. They will scale, they will be faster, so more protocols will potentially adopt those technologies. So things may get more and more obscure. That's one thing. That's on the base layer, like on the blockchain layer. And the other layer is, I think, more like if blockchain does not, like the base layer does not scale, like if Bitcoin does not scale in terms of like transaction per second, a lot of volume will happen on upper layers. And I think the higher you go in the layer, the more obscure it is, the less auditable it is. So for instance, what Nick and Dan just mentioned about the exchanges being a black box. In fact, exchanges are layer 2. They're basically a layer 2, centralized layer 2 scaling solution for
Sidechain.
Yeah, exactly, sidechain for layer 1, and it's impossible to track those. The only people who know these these transactions are the owners of the exchanges themselves. So I think over time things might get more and more obscure, but it's not necessarily like a bad thing. Like.
Doesn't that kind of take away all the point of having settlement on-chain and the transparency and the aggregate and being able to prove the bare assets?
I'm sure some transactions will have to settle on layer 1. Like even if a lot of transactions happen on Lightning, some of the bigger ones should have. Like layer 1 is basically the settlement layer, and therefore, like if layer 1 does not scale, then chances are the volume of each transaction settlement will be higher, much higher in the future. That's assuming if privacy technologies don't get adopted.
On layer 1.
On layer 1, yeah.
Which is right now, that is the plan for Ethereum 2.0 or PEP.
Who knows?
I just really want to
Yeah,
see
who knows?
that.
Only metallic.
Yeah, I wasn't aware if Ethereum is adopting any more privacy technologies, but something like Zcash, these people are working on really solid moon math, what they call moon math for layer 1. So
It's a very delicate balance. On one hand, you want transparency on layer 1 for proof of solvency or proof of reserves. Also, I think something that most people don't bring up is efficient market hypothesis. I would love for the financials of every major company to be transparent. It'd be awesome if Coca-Cola's address was known. If Bitcoin becomes the unit of account, then you can have trading algorithms trade based on the amount of cash flow going through Coca-Cola's address. And that makes the world a very efficient place in terms of information. So I believe that that's a very kind of underappreciated aspect of layer 1 for Bitcoin right now with its full transparency. I think it's a hybrid approach, which Zcash approached, I think, very elegantly. The shielded versus unshielded transactions. I think Bitcoin will approach it in a similar fashion with Schnorr signatures and CoinJoin. So where with Schnorr and CoinJoin, you can have pretty good privacy on layer 1. Without CoinJoin, it's still pretty transparent. Also with Zcash, we saw that if you don't have full transparency on layer 1, if a lot of it's obfuscated, then there's the Zcash inflation bug problem, where we don't know if that whole supply is, if there's more than 21 million Bitcoins or not. And I think that's paramount. Digital scarcity is what we're really building, what Bitcoin really really did well. So I think it's a delicate balance.
So before Nick goes ahead, I just want to follow up on that. And then you can go, you're gonna like this. Going forward, we've been hearing for the past year the institutions are coming, and they're finally here. And part of their solutions is a lot of new intermediaries, some of them off-chain, some of them on-chain, and of course the risk of rehypothecation. So then the question becomes, how does banking on blockchain, Bitcoin / Ethereum look like, and how does that change the economies of scale of our market?
Well, all the custodians that I know of, they don't do omnibus, so they don't commingle funds as of yet. So each person who or each institutional trader that custodies their assets at different custodians, they have an actual address. so they can validate that their funds individually are there. So I haven't seen commingled funds yet. If we saw that, and we saw a lack of transparency in terms of proof of reserves, then I think we would enter the same problem that we had before.
Well, I mean, Coinbase commingles, don't they? They don't have segregated accounts for retail depositors.
Not retail, I'm talking institutional.
Institutional,
For the custody
yeah.
side.
Unfortunately, I think commingling is going to be pretty rampant, from what I understand of the custodians that I know.
They're going to offer them money.
So to answer the prior question, I think Dan's right. There's a huge trade-off between auditability of supply and privacy at the base layer. Every single serious privacy project has been exploited with an inflation bug or potential inflation bug. CryptoNote, ZeroCoin very recently, and then Zcash. ZeroCoin being an earlier version of what the Zcash scientists built, and then people built coins with the primitive version, and they all got exploited. Now they're all basically, do not touch. And Zcash, we don't even know if it was exploited or not. So and Monero, the CryptoNote had an inflation bug which wasn't exploited. Monero was exploited in Bitcoin. So the point here is that the trade-off is serious, and people may not end up trusting base layer privacy coins just based on the accumulated evidence we have at hand. However, if you have technologies like confidential transactions, and to my knowledge Zcash as well does this, you can do selective disclosure where you show that you have ownership of certain an account or some coins. So you can use selective disclosure for a lot of the things we're talking about. So it's not like a deal breaker. If everything were totally private and even you didn't have the ability to demonstrate your funds, then finance wouldn't really work well. Like, you need to prove to an auditor that you have a certain amount. So I think the trade-off is actually unacceptable in terms of real confidential on the base layer. I think auditability should win, probably, just based on the accumulated evidence we've seen so far. As Kiao says, many like sidechain-like elements or layered scaling, which I think we understand is sort of the way forward, that will totally obfuscate a lot of the volume, but it should have an imprint at the bottom eventually. Like, Lightning should periodically settle to Bitcoin, or else the security guarantees aren't real. These things, the transactions that happen on the higher layers occasionally do settle, and so you still have useful information.
Let's open this up for questions, if anyone has any.
So just to clarify then on auditability, which I kind of agree with, you were saying more specifically that auditability is really not for the auditors, it's for everybody participating in the system to have guarantees about it.
I would say it's for both, but it's very important that people generally have confidence in the integrity of the chain. And you kind of lose that when you have these like real serious confidentiality.
And I think layer 2 with Lightning, that uses onion routing, which is essentially what how the Tor preserves privacy. So we're talking about a pretty good private solution on layer 2. And they're not going to, Lightning channels don't stay open forever. They have to eventually settle. I guess you could have a channel open forever if you wanted to. But most are going to be practical and want to settle after X amount of time period.
And Schnorr hides that you have a channel open.
Yeah, Schnorr with it aggregating signatures.
Because now you can tell, you can look at the number of channel openings on Bitcoin, but Schnorr would let you disguise that you are opening channels. So privacy will be, for Lightning, pretty good once you have Schnorr.
Yeah, I think Lightning brings about a great amount of privacy for Bitcoin.
But then the question is, what kind of metrics are you looking at Lightning in order to gauge the consumption and the different transactions that people are using?
Well, just like how the internet works, there's certain data providers who look at certain choke points of the data and go and take a measurement as up to 1%. Maybe they run like 10 full nodes, 10 Lightning nodes. And they take that and look at what they hypothesize might be all Lightning nodes and extrapolate economic activity.
Yeah, so that's what you would do in practice. You would sample the Lightning network and try and find out, infer things about it. However, people can set up nodes between themselves, which they don't publicly call attention to as being part of the network. In that case, you really can't know what any of the transactional activity is like, but I think what you would see is the data providers would set up their own big nodes and then try to seed them with liquidity and then infer what the nature of the network is like. But it's funny, this is actually a critique lots of people have of Lightning, is that you don't have KPIs. It's like, well, how are we meant to know if Lightning is successful or not? Well, I don't know, like if people are using it, not all data will be available. It's just kind of, unfortunately, the nature of the beast.
Okay, do we have any other questions out there? Or maybe we can just touch on one thing that we haven't, which is the DPOR. We very briefly mentioned crypto-based lending and make or die. And the question is how fairly do we really estimate the aggregate crypto-based lending fees, DPOR, as I think it was Masari that named it.
Siri.
And, sorry?
Ours is Siri.
Siri, I'm sorry.
The blog is Diaper.
That's true.
Real mature.
I mean, it's a LIBOR, Diaper.
The question was basically, how do we see that fitting into the systematic risk? We were just briefly mentioning this earlier in terms of probably about 10% of Ethereum is transaction fees, and then we're looking down under of, say, single digits of Ethereum being locked up and out of the total token supply that's on chain. And now we have different rating and the synthetics creating their own transactions and bundles coming up next and derivatives based on that. And this is before we're even launching the new coins. Are you guys looking into gauging that risk or looking how that plays out?
I like that in DeFi you can sort of price the risk, because it's transparent for the most part. So that is one
Not
thing.
the systematic risk of the underlying asset, though.
No, that is kind of unknowable. But the volatility of ETH is knowable, of course. So you can sort of predict how your CDP is going to perform, under various assumptions. But the thing that I like about DeFi is that it is like you can really assess the viability of a loan, for instance. So I think that's actually one of the positives, is that it's like quite transparent.
Because it's collateralized at a very high rate.
Well, I'm not saying that these loans are good, or you should be making or taking them, but I like, as a data nerd, that I can see them.
But wouldn't that be the same kind of recycling we were talking about earlier in the ICOs, right?
But
If you have
it's
treasuries,
deliberate, it's very transparent about the fact that there is leverage in the system now. I'm kind of okay with it existing as long as it's known.
or it doesn't explode.
Well, yeah. Have you guys a view?
So I'm actually not really worried about lending in DeFi right now because pretty much all the lending is over collateralized at 200, 300, 400%. The point where I would be worried is when people can actually start doing uncollateralized loans in DeFi. But I think that may take a while before that can happen. And the reason for that is if you want to do an uncollateralized loan, you need some kind of credit scoring. And in order to do some kind of credit scoring, you probably need some kind of identity system on the blockchain.
Yeah.
So that will take a while to happen. Like building an identity system is not trivial. Like the tech might be easy, but bootstrapping the network effect, the initial critical mass of users is extremely tough. But by the way, I'm pretty excited about Microsoft's project building their decentralized identity system on Bitcoin, which is very interesting. But back to the original point, I'm not worried about DeFi, the lending in DeFi right now. What I am worried about is lending in non-DeFi because in CeFi because the lack of regulation. And in the absence of the lack of regulation, there will be more leverage. And a lot of that leverage cannot really be seen, it's not auditable. So I think regulation is important.
So I can counter that if people are buying the ETH in order to collateralize that on a credit card at Binance with Bitfinex, you still have a very over-leveraged Asian market coming in and collateralizing their so-called owned asset on ETH. So that's one risk that collateralization does not resolve. Also the risk of the Ethereum as the base layer and the commodity that you're really trading. You don't know the effect of increasing the CDP or the diaper or the rates going up. I'm never going to say that again, Anyway, thank you so much for coming tonight, and thank you for hosting us.
Thank you for coming. Thanks for doing this. Thank you, Joe. Is Joe here? No. Thanks to McCarter.